strategist and managing director at Oppenheimer Asset Management, and he joins us now. John, thanks a lot for joining us, and Happy New Year. You and your colleagues at Oppenheimer did indeed generate some headlines in mid-December or so when you rolled out a price target on the, or a target on the S&P 500 of 7,100 points, 7,100 points. That's about 21% higher than we are right now. Why are you so bullish on U.S. stocks?
Well, at the time that we set that target, and first of all, Paul, great to be on the show with you. Happy New Year.
Thank you.
When we set that target, it was about 17% upside is what we were looking for. We still stand with that now with a further distance to go. We think that what we had here is essentially Santa Claus came earlier, and then towards the end of the year, the bears got a hold of the market. But it wasn't just the bears, because fundamentals, in our viewpoint, remain very much intact, whether it's the consumer, even though there's been some slowing, but the consumer is still showing resilience, business showing resilience. If you look at S&P 500 earnings and revenue growth over the course of the last 3 quarters reported, let's see, we think fourth quarter is going to look pretty good when it starts up on January 15th when the big banks start to report. But in addition to that, monetary policy has been extremely sensitive, to both mandates in terms of curbing inflation, while at the same time watching the job growth does not fall significantly. In essence, looking for full employment to stay in that range of around 3 to 4%. We're a little bit over 4% on unemployment, rather. And what we do expect is the Fed will remain very sensitive, as it has been, to practicing its mandate since March of 2022, when it got back from, it got out from being under behind the yield curve. So what we're looking at here essentially is an environment that should be good for cyclical stocks. We continue to favor cyclicals over defensives. We remain overweight the U.S., and our favorite sectors remain technology, communication services, which is about 70-some% tech. It's got the streamers, it's got the social media, and it's got the search engines in it, that one. We also like industrials, we like the consumer discretionary, and we like the financials going into this year.
How much of a factor, if at all, is the incoming administration in the White House, the second Trump administration?
Yeah, our viewpoint on the Trump administration is essentially, like we hear from others around the street, but in our own view, is we think it's a positive approach to business, favors business, which should be good, we believe, for job growth and continuing the resilience in the economy. We think the areas of concern that seem to be what plays through on a day-to-day basis through a lot of trading desks, of course, is what's the story on the tariffs. We've got to remember that let's make a deal president tends to be rather dramatic in what he calls his first moves in any kind of negotiation. So we expect that the real play here is the fact that the U.S. economy remains the consumer economy of the world. It is a buyer in size for most countries. So we think the negotiations will likely be much more productive rather than finding standoffs, and also one that will be realistic in terms of growing jobs in this country in the area of things like that are attached to areas that are sensitive to national security, and also I think pharmaceuticals, sensitivity to that in terms of where we don't have to import all our drugs in this country, that we need to stay healthy and to have vaccines and other things available, so we don't go through what we had with COVID-19 before. But the outlook remains, there's never a time of uncertainty. And we think the markets actually like uncertainty because traders play on the uncertainty. That's what helps fill those cups with lots of bips that creates vanity license plates on fast cars that you see around Manhattan every so often. And the other side is for intermediate to longer term investors, which my team particularly works for, it creates an environment where you get to catch the babies that get thrown out with the bathwater in some of these pullbacks, where you get a broad array of stocks gets knocked down. They're dropped like hot potatoes at times, but you wind up picking up some things that you before seemed a bit more expensive. So we think the current pullback is healthy. We think it's more of a trim than even a haircut, but it could become a haircut as we wait for the new administration to fill the chairs on January 20th. Meantime, the play here seems to be one that creates volatility, but we think overall the economy is remarkably good, and very few people can deny that. And we believe it's sustainable with resilience. We're not looking for a hot economy, trees that grow to the sky, but rather a situation that offers both opportunity, but there's always some risk, and that's the important thing. Right? We think people need to be diversified, know what they own, know why they own it, and how it will perform at different points in an economic cycle that is highly transitional, not just because of an new administration in Washington, but also moving towards a normalized interest rate regime, which the Fed is working very hard on.
John Stoltzfus, thank you very much, and best wishes